President-elect Trump is looking at signing an executive order on his first day in office that would impose a 25% tariff on goods from Mexico and Canada. This in addition to threats for more tariffs on products from China and other countries. Joining us now to talk about the potential economic impact, former White House counsel and economic advisor, senior trade economist Christine McDaniel. She's a senior research fellow at the Mercatus Center. And Richard Stern is a federal budget policy director at the Heritage Foundation. Great to have you both. Christine, I'll start off with you. Is this just an opening salvo, or do you think that it actually gets signed, via executive order on the first day?
We don't know yet. What we do know, though, is that, if the tariffs do come into play, they won't be costless. And so, I'm really hoping that the administration can get something out of these tariffs, by either working with other countries, if it's for protectionist purposes, making sure the domestic industry has a plan, and, importantly, knowing what you want, right? President Trump can be very good at making deals. And we see that it works when there is a clear, gettable win. And so I'm hoping that, this administration knows exactly what they want from the tariffs, and other countries are willing to make deals.
Let's talk about that gettable win, Richard. Some are saying that Mexico, in response to the threats, has already moved to stop immigration across the border, has moved to stem the flow of fentanyl across the border. Is that a gettable win? Because ultimately, who is going to pay the cost of that tariff? It's going to be the American consumer. I mean, the Wall Street Journal had this article yesterday about the most affordable autos. Most of them are made in Mexico. It could mean a $3,000 increase to the price of a $30,000 vehicle if there are tariffs put in place. That's sort of the risk reward here that we're balancing, Richard.
Well, absolutely. But I would say this, though. So some of the tariff burden is felt by foreign producers. And the other piece of that also is, keep in mind that we're going into a tax debate next year, as a lot of tax provisions are expiring. The revenues raised from these tariffs could easily be used to cover the deficit impact of cutting taxes that would be pro-growth for the economy, that would put money back in the pockets of American families. And in fact, most of those tax cuts that we would like to do and extend are vastly more productive for the economy than the modeled harm that even Tax Foundation and other groups have talked about from some of the tariffs. So even using that way would be a win, to raise revenues, to use it to cut other much more harmful taxes. But certainly a third of Mexico's economy is related to exports to the U.S. I think the movements you're talking about are already showing that they are willing to work to try to avoid those tariffs by following through on their commitments, by closing the border, by not just letting cartels and drug groups run the southern border. So I'm very optimistic about what will come from this.
Let's talk about the money raised. I mean, the Tax Foundation is saying a 20% universal tariff could raise $3.3 trillion for the government from 25 to 34. Christine, that's not costless. I mean, there is a cost, for businesses who are anticipating the onslaught of tariffs. They're bringing in goods right now. They're storing those goods right now. All of these things cost money, even if it's to store inventory gotten at current rates, Christine. So how do you sort of weigh the $3.3 trillion that is just the dollar amount on paper versus the sort of unintended consequences, the side effects, the other costs that are hidden?
Yeah, no, I mean, look, Richard is exactly right. I mean, the tariffs can at least partially pay for the tax cut extensions. The problem that, you worry about, though, is the inflationary effects of all of this. And so, and so that's where I'm really hoping that the plans to cut government spending can be materialized. We know that for every 1 percentage point of government spending to GDP ratio that they can shave off, that can have some material, anti-inflationary effects. And if you just do some back of the envelope to pay for these tariffs, at least in terms of the inflationary effects, to combat that, to counter that, they could find $1 trillion to shave off government spending. That could definitely do a lot to counter the inflationary effects.
Right. Richard, I want to talk about these tariffs through the prism of the financial markets, because when you talk to market participants, investors, traders, they will say that, with an onslaught of tariffs, that's going to be bad for the markets. Can you talk us through why it won't necessarily be bad for the markets?
Well, first of all, whenever tariffs are imposed, but certainly if we do what I would like to do, and Peter Navarro has written about as well, which is a border adjustment, where you tax imports coming in, but you also exclude your exports going out the door from your own tax base, then the US dollar would strengthen tremendously. And in fact, the strengthening of the US dollar would offset an enormous amount of those costs, right? So a stronger dollar makes it easier to purchase imports, and it deals with a lot of these issues. So that certainly first would calm markets. But the other thing also to keep in mind is that kind of dollar appreciation makes it vastly more enticing and lucrative to invest right here in the United States. And the other part I'd bring up about this, of course, is that all of our trading partners, including Mexico, have VATs, which work like sales taxes. In fact, Mexico's is 16%. All of these are not applied to these countries' exports, but they are very much employed on our exports to them, their imports. And so that works like a tariff. And so all of our trade partners have these taxes. They mechanically work very similar to the tariffs. And so by not having some kind of border adjustment like this, it's actually meant that for decades, the American taxpayers subsidized foreign production being imported into the US and double taxed our own production that's exported. So working to correct that both can raise those revenues to cut taxes here that are much more harmful, but also can close that loophole that has been disastrous for production here and has chased investment dollars out of the US market.